Behavioral Finance 101, an introduction to understanding investor behavior. Behavioral finance is a field at the intersection of psychology and economics that studies how cognitive biases, emotions, and social influences affect financial decision making. Traditional finance rests on the assumption that individuals are rational agents who seek to maximize utility, efficiently process all available information, and make consistent choices. However, repeated empirical observations have shown that real-world behavior often deviates from these assumptions. Investors overreact to news, underreact to fundamentals, follow fads, and panic during downturns. Behavioral finance does not dismiss the mathematical elegance of traditional models, but seeks to augment them with more psychologically realistic accounts of human behavior. From rational to irrational, a shift in thinking. The rise of behavioral finance represents a fundamental shift from the notion of perfectly rational markets to the recognition that irrationality can be systematic and predictable. The efficient market hypothesis, long a pillar of financial theory, posits that asset prices always reflect all available information, leaving no room for persistent anomalies. However, episodes like the dot-com bubble, the 2008 financial crisis, and even the GameStop short squeeze of 2021 suggest otherwise. These events highlighted how collective emotions and narratives could drive prices far from their intrinsic values. Behavioral finance offers explanations grounded in bounded rationality, recognizing that people make decisions under constraints of time, attention, and information processing capacity. This perspective aligns more closely with how individuals actually behave in uncertain, high-stakes environments. Cognitive biases and heuristics. Mental shortcuts, or heuristics, often lead to systematic patterns of deviation from norm or rationality in judgment, known as cognitive biases. At the core of behavioral finance is the understanding that people do not always make decisions through systematic analysis. Instead, they use mental shortcuts, or heuristics, which simplify complex problems, but often introduce biases. Overconfidence bias leads individuals to overestimate the accuracy of their beliefs and forecasts, frequently resulting in excessive trading, under-diversification, and poor investment performance. Anchoring bias occurs when individuals fixate on an arbitrary reference point, such as a past stock price, even when it has no bearing on the asset's current value. Representativeness bias can lead investors to misinterpret random events as patterns, such as assuming that a string of positive earnings reports guarantees future performance. Confirmation bias reinforces pre-existing beliefs by filtering out contradictory information, making investors prone to echo chambers and one-sided judgments. These biases are not isolated quirks, but have structural implications for market behavior. For instance, when many investors anchor on past market highs, resistance levels form that influence future price movements. Similarly, overconfidence at the collective level can inflate asset prices during bull markets, only to magnify panic during downturns when expectations are suddenly corrected. Emotions in financial decision-making. Emotions play a significant role in financial decisions, with fear and greed acting as primary drivers, making it crucial to understand and manage emotional biases. Emotional responses are integral to financial behavior and often override logical reasoning. Fear, greed, hope, regret, and pride all shape how people save, invest, and respond to risk. Loss aversion, a central concept in prospect theory developed by Daniel Kahneman and Amos Tversky, suggests that people feel the pain of losing money about twice as intensely as the pleasure of gaining it. This asymmetry explains behaviors such as the disposition effect, where investors hold losing stocks too long and sell winning ones too quickly. Additionally, regret aversion can cause people to avoid decisions altogether for fear of making the wrong one, leading to inaction in portfolio rebalancing or delayed entry into markets. Emotional contagion, the process by which market sentiments spread like a virus, can exacerbate volatility, especially in high-frequency trading environments. The 2010 flash crash, where the Dow Jones Industrial Average dropped nearly 1,000 points in minutes, reflects how rapid emotionally charged decisions, and algorithmic triggers can intersect to create chaos. Social and cultural influences on financial behavior. Behavioral finance also acknowledges the role of social influence and cultural context. Herd behavior is one of the most powerful social forces in financial markets. When individuals follow the crowd, believing others possess superior information, it can create self-reinforcing price trends and asset bubbles. The real estate frenzy before the 2008 crisis was driven in part by a collective belief that housing prices could only go up, supported by media narratives, peer behavior, and lax lending practices. Cultural norms also shape financial behavior, including attitudes toward debt, saving, and investing. For example, countries with high levels of social trust may exhibit different risk profiles and participation in equity markets compared to those with greater economic insecurity or mistrust in institutions. Narratives and stories play a crucial role in shaping market movements. Behavioral economist Robert Shiller has emphasized the concept of narrative economics, where viral stories and cultural scripts influence collective expectations and financial behavior in ways that traditional models cannot capture. Market trends often have a storytelling component, whether it is the rise of the green energy revolution or the mythology surrounding disruptive tech startups. Market-level implications and anomalies. When individual biases aggregate, they can give rise to market anomalies that challenge classical theories. Examples include momentum effects, where past winners continue to outperform, and post-earnings announcement drift, where stock prices respond slowly to new information. These phenomena are difficult to explain under efficient market assumptions, but align well with behavioral explanations that involve underreaction, attention constraints, or limited arbitrage. Importantly, behavioral finance also explores why rational traders cannot always correct mispricings. The concept of limits to arbitrage explains that even if sophisticated investors recognize irrational behavior, they may be unwilling or unable to bet against it due to risk, uncertainty, or institutional constraints. This helps explain the persistence of pricing bubbles and speculative manias. Applications of behavioral finance span several key areas. In investment strategies, psychological factors such as herding, overconfidence, and loss aversion help explain market anomalies and guide more realistic approaches. Risk management incorporates these insights to address distorted perceptions of probability and loss, reducing fear or optimism-driven errors. Portfolio optimization recognizes that investors often prefer psychologically comfortable allocations over purely rational ones. In policymaking, behavioral finance informs nudges and regulations that encourage more stable financial behavior. Finally, economic forecasting accounts for the role of sentiment and collective biases alongside fundamentals in shaping market trends. Understanding behavioral finance has practical value in both personal finance and institutional design. Investors can improve outcomes by becoming aware of their own biases and implementing strategies such as diversification, long-term planning, and the use of checklists or decision aids. Financial advisors often act as behavioral coaches, helping clients stay disciplined during market turbulence and resist panic-driven decisions. Governments and regulators are also increasingly applying behavioral insights to promote better financial decision-making. One prominent example is the use of nudges to increase retirement savings. By making enrollment in pension plans the default option, rather than requiring opt-in, participation rates rise significantly. Such interventions rely not on coercion, but on understanding predictable behavioral tendencies like inertia and status quo bias. Conclusion. Behavioral finance offers a richer and more nuanced understanding of financial behavior by integrating insights from psychology, sociology, and economics. It explains why markets can be volatile, why investors often make poor decisions, and how collective beliefs can shape economic outcomes. As the financial world becomes more complex and fast-paced, the relevance of behavioral finance continues to grow. It does not reject the tools of traditional finance, but refines them by grounding economic models in actual human behavior. For researchers, investors, and policymakers, behavioral finance opens a window into the hidden drivers of economic life and offers strategies for navigating its uncertainties with greater awareness and realism. Stay tuned for more insights into business and the social sciences. If you found this overview helpful, don't forget to like, subscribe, and comment on future topics you'd like us to cover. I'm Dr. Dag, wishing you a fantastic day ahead.